All right, hello. I found my board, my beautiful board. Welcome. Okay, let's do a little case study here. And a couple of things that you've been asking about. You've asked about the S&P. And the S&P, as it's called, or the S&P 500, or SPY, which is the name of an exchange-traded fund, which is an index that follows it. All there. Here's the question. Why can't traders or advisors beat the S&P 500? Here is a case study to dive in to the S&P 500, what it is, why it grows, where it goes, and why people can't seem to beat it, which means an index sitting in your IRA or 401k, whatever you have on that, or in your little brokerage account you have over at Robinhood or Schwab or Vanguard or wherever it is, Fidelity or E-Trade, I want to name all of them because we don't favor any of them, is part of this index. So let's go take a look. Traders or advisors can't beat it, and usually you can't either. So if you can't beat them, join them. Let's look at some headlines. So May 14, 2024, that's earlier this past year, but you can watch this anytime because this is the story of the S&P 500 and why you can't beat it, but it just shows you even Warren Buffett today, with all that historical success, says, you know what? I believe in the S&P, and are they really worth it? Yeah. Why does he believe in it? Because it's so damn hard to beat. Then, Motley Fool want to outperform 88% of professional fund managers. Buy this one investment and hold it forever. What are they talking about? An S&P 500 ETF index fund. And Wall Street Journal from July 5th, that's not too long ago, talk about fireworks, why your fund manager can't beat today's stock market. Wow. And today's stock market is basically the S&P 500. There you have it. So everybody seems to be in agreement it's hard to beat. So what is it? Where does it go? What does it go? What must it go up? What's it go down? And let's take a look. Over time, the S&P 500 index is positive. Let's go back, what is this, 30 years? 1994, sitting right here. So we go back 30 years. We have what we called the nuclear winter, which was the recession, 2000, 2001. Then we have the financial crisis. Yeah, go watch the movie The Big Short. You'll see what this is all about. So that's 2008 and 9. Then you have the little COVID recession right here. Wah! But take a look. Go from here all the way back to here. Here, it's at 1,000. Check this out. It was sitting there at 2,200. Oh my gosh, will we ever live again? Yep, well, it came right back up to 2,400 just in time for the financial crisis. But then it's grown past that. And now look what we've had despite the yahoo that we had right here for the COVID recession. Guess what? You're up over 5,000. So 30 years ago, if grandma had bought some S&P 500 index and just left it in her IRA, that amount of money would be up 5 times, 5.4 times to be exact. So basically, over time, it's a good buy and hold. And that's what one of those headlines that Motley Fool was talking about. Hey, take part of your portfolio, buy and hold. There it is. So what's the reality? 88% of those large cap fund managers underperformed S&P over the last 16 years. And these are professionals working for the usual suspects of companies, managing your 401k, your IRA, maybe your private investment fund. Wow. Warren Buffett, there he is again. He told CNBC, I've had a tough time trying to beat the S&P 500. Isn't that interesting? The Oracle of Omaha, as he's called, says, I've had a tough time doing it. Then most hedge funds, mutuals, underperform the 500 over an extended period of time. And whenever you see extended period of time, you know, that kind of language, and I took this language from a report, they're usually referring to about a decade. An extended period of time is 10 years, like your 30s, your 40s, your 50s. You see what I mean? 55 to 65 from retirement age. That's what they're thinking. And finally, why? Simple. The S&P 500 is a big old pool of stocks, and they refresh the holdings constantly. Underperformers are replaced with the up-and-coming growth. And there's so many of them pointing out that the market itself is like a great big mutual fund when it relates to the S&P 500, thought to be the 500 best. Isn't that interesting? Now let's go into it. Who drives the S&P? It's driven by huge leaders. In 2023, the Magnificent Seven was 29% of the market cap. So you add up the value of all 500 companies, and 30% of it was the Mag 7. And the Mag 7 grew 71% in 2023. The other 493 and 7 is 500. Back when I went to school, they only grew 6%. And ladies and gentlemen, when you put it together, we'll do the first chart second and the second chart first. Here you go, Magnificent 7. Facebook, Meta, Amazon, Apple, Microsoft, Google, Tesla, and NVIDIA. NVIDIA, woohoo, AI chips. So here you go, 71% for them, ding, 6% for everything else, ding, and the S&P weighted average, 19%. Hard to beat that, so it's 19%. So let's say you, on your IRA, just said, well, look, I'm gonna do 33%, S&P at 19%, and I'm gonna do 33%, just a money fund, at 5%, because interest rates are higher, and the other 33%, I'll take some other, mutual funds or other risk, or I'll buy a few stocks. Interesting. And so you can see that's how the blend happens. Then you take a look here. Right now, we are living in a fairly spectacular age because it usually sits 22% peak, 14% low. That 14 to 20% is the high-flying 5 to 10. In this case, they're counting 7 largest companies historically if you went back. So right now, this is an over-index, primarily driven by the overwhelming response of NVIDIA. It's a new world and new chips, and it's a new area. So you can see this is why the index did so well, and it's driven by huge leaders, and right now it's enjoying some of the biggest returns. But if you take a look in here, this went up and down market cap, but you go back and look at that chart, it was still had its ups and downs, its freaky moments, but over time, it was returning good money for people that buy and hold, just like the Motley Fool and Wall Street Journal's article said. So now, what are the lessons for us with the S&P? First, you may have a good season on a particular stock. You got together with all your buddies and you bought some NVIDIA at the beginning of 2023, and it went up, and you saw the S&P, and that was an unusual time. So maybe you bought some S&P and you had some cash and some NVIDIA. You really had NVIDIA twice, inside the S&P at 19% for 2023 and outside. So that's great. But you know what? You may be an Amazon, Apple, and NVIDIA lover, and you may have a good season, but you can't do that consistently. Warren Buffett can't do it consistently, and 80% of the pros can't. So if you got lucky, back off. Be sensible about portfolio theory and understand that if they can't, you probably can't. And if you really think you can, you need to look up a word in a dictionary, hubris, H-U-B-R-I-S, because you are lucky rather than good, and time will probably prove it, but I don't wish losses on you. Modern portfolio theory. Modern portfolio theory is focused on U.S. equities as being linked to risk and other items in your portfolio being linked to risk, and applying the risk this way. The older you get and the more obligations you have, you should reduce your risk. I'll give you an example. The older you get, the less time you have to recover from a market crash, so the less risk you should have to open stocks. Second, what kind of obligations do you have? Are you married? Do you have a spouse? Do you have any children? Do you have stepkids? Maybe you just got married to somebody, you have stepkids. Do you have an older parent, like maybe a mom who is a teacher and she's going to be on a teacher's pension, but she's going to come live with you ultimately? All of those things are obligation. So the closer you get to retirement in your age and the more obligations you have, you should drop your risk. That is very simple portfolio theory. Make sense? Because you have less time to recover from a market crash and less years to make compound interest going into the future. So basically, if you apply portfolio theory to this, the S&P 500 and cash, high yield savings accounts, and a few equities, the mix of those. So right now, someone who's 60 years old with family and everything might be up to half S&P 500 index and 33% cash and only 15% risk. See that example? And the risk may be individual stocks, things like that. So this is the lesson for us on how the S&P plays into that in terms of modern portfolio theory and retiring. Now, I know that some of you may put in the comments, no, you explained that wrong, it's different, go look up age-based portfolio theory, modern portfolio theory, a variety, and you'll see how the dynamics are discussed. How many years you are old and how many years until you retire and what kind of obligations you think you're going to have. Kids going to school, parents come to live with you, all feeds into the more you have of years and the more you have of obligations, lower that risk because you've got less time to recover. So, interest rates at 5% have made high yield savings coupled to S&P, a combo that's tough to beat. Whether that's 10% because you're in all about stocks and you're 21 years old, or if this is 90% because you're grandma and you want very little risk anymore because you just don't have time. That's the lesson for us, and that is the story of the S&P 500 and why it's so damn hard to beat, but why it's so damn good historically as an investment choice. I'm not a registered investment advisor. Talk to people that you know who are. Get yourself an account with a reputable organization, make your own decisions, but along the way, take a long, hard look at that SPY and other indexes that track the S&P 500. I'm Tom Ellsworth, the Biz Doc. Thanks for watching this one, case study on Standard & Poor's 500, the S&P 500, and I will see you next time. Now, if you like this one, go check out these two that are in the Biz Doc archive. As always, I'm Tom Ellsworth, the Biz Doc, and I hope I left you better than I found you.